Good evening, Midlands African Chamber. Welcome to another edition of the Power Hour. I am your host, Shay Ololafe, and with me today we have Mr. Adam Feeney with Lamson, Dugan, and Murray. But before we begin, as is custom, we go over some announcements that are coming up, events that are coming up in our community for the Midlands African Chamber. First and foremost, we do have some member-only events. So if you are not a member, this is your opportunity to join us and join our tribe so that you can get some of these additional benefits and value to growing and scaling and maintaining your business. First and foremost, we do have a digital marketing course presented by Meta that's going to be virtual this coming Saturday. That date is going to be March 18th, and the time is from 10 a.m. to 11:30 a.m. You can go register on our website. But again, this is a member-only event. So in order to attend this event, you want to be a member. You need to join the tribe. The second member-only event will be later this month on March 31st. It will be from 4 p.m. to 7 p.m. and it will be at Modus Co-working. And that event's going to be our investors meetup. This is an opportunity for you to gain knowledge, network with traditional, non-traditional investors for your businesses. This is an opportunity for you to, again, get the capital you may or may not need. That event is limited to the first 30 attendees. So again, this is another members only event that you do not want to miss. So if you are a member, I encourage you to show up. If you're not a member, I encourage you to become a member and then show up. And last but not least, we have in April, we have our roll call being hosted by the Business Ethics Alliance. Attendance is free, and that again will be at Modus Co-working. And you are welcome to, anybody is welcome to join our roll call. So without any further ado, I would like to introduce my good friend, Mr. Adam Feeney, who is with partner at Lamson, Dugan, Murray in the litigation department. For those of you who don't know, Mr. Feeney has been a litigator and has went around the world and seen very much when it comes to the businesses and what it takes in order to ensure that your business is operating, and more importantly, it complies with what its mission is. So without any further ado, let me go ahead. Sorry, Adam, I forgot to include the PowerPoint. Let's do that.
Great.
There we go. Perfect.
All right. Well, thanks a lot. And thanks everybody out there for taking the time to watch this today. I hope you get something out of it. And, I don't know everybody out there, your level of familiarity with some of the subject matter, but, I'm trying to tailor this to be as general to where if you specific so that, maybe if you are familiar with some of these issues, you'll still get something out of it. So this presentation is about the importance of drafting and following corporate agreements. And so what does that mean? It means that, we're going to talk about different types of business entities here, and we're going to talk about the types of agreements, or basically the rules that you can create for how that type of business is going to run, and, kind of some pros and cons and some best practices type of things. So, this is not legal advice. This is just kind of you getting some ideas about things that you probably want to be thinking about when you're thinking about your approach to what type of entity you want to run your business as, and also how you want to set things up and run things and document things. So just to be very general about this, when we talk about business entities, right? So you have your business, you're making candles, or you're running a food truck, or, whatever, you're managing, musicians, anything you do, right? That's your business. And that's probably what you're focusing most on, is how am I going to provide some service or some good and make money off of it, right? But then for people behind the scenes like me and other lawyers, we're thinking about this in terms of, well, okay, So your business isn't just what you do, it's how you structure things, what legal entity are you running things through, and that has important consequences down the road. So obviously, when you're starting a business, you're probably focused more on, the actual business part, like what am I going to sell? But these things are important too, and you want to get them figured out towards the beginning so you don't have problems down the road. So we're going to talk about 4 different business entities. There's more than this, but this is kind of a general lay of the land. You got a sole proprietorship, a general partnership, a limited liability company, and a corporation. So we'll kind of give an overview of these and then talk through the different types of agreements that they have. So sole proprietorship, this is the default setting. This is, okay, so I want to start doing a business and then I just start doing it. That's what you are by default. So, hey, I got a lawnmower. I can make some money mowing people's lawns. You start doing it. You're a sole proprietor. Or, hey, I can make some product out of my house and sell it. You don't do anything else. You're a sole proprietor. So as the name suggests, that's a business owned by one person that's not incorporated into a business entity. So you don't have any sort of legal structure. You're just one person doing a business. You can have a doing business as name, but it's still a sole proprietorship. So a doing business as name is like a trade name. Like, let's say, I start a lawn mowing service and I want to call it, Best Green Mowers, right? That's just a trade name. That doesn't mean that there's any sort of legal entity there. It's just your trade name. You're still a sole proprietor for, the person that's running that business. And this is actually the most common because it's the default, right? So 3/4 of all businesses I read are like this, mostly because people just want to start doing a business and they don't want to think about the rest of it. And, it could be fine, but the big issue is that there's no legal distinction between the business and the owner. So what does that mean? It means that if, let's say I'm running, Best Cut lawn service, but it's just me out there mowing lawns. So there's no difference between any debts of my lawn mowing company and me individually. And for example, if I'm mowing somebody's lawn and I hit somebody's BMW and I cause a bunch of damage, it's not like they're going to they don't go after the business because there is no legal separate entity. They go after me for that liability. So you don't have any liability separation between you and your business. So, and if you have debts, you got a supplier or something that you owe money to, they don't just go after the corporation or legal entity because there is none. They go after you. And you generally pick things up on your own personal income taxes. And there's no operative agreement for how you run a sole proprietorship because it's just one person running it. So that's the default setting. Kind of the pros of a sole proprietorship is that it's easy to set up because there really is no setup. You can just go out and start doing a business, and then you're doing a business as a sole proprietor. You might have to get, licenses for certain types of businesses, that anybody would need to get, but that's not unique to, sole proprietorship. So whatever business you can do under the law with whatever license you have, you can do it as a sole proprietor, immediately. You don't have to file any papers or anything. Yeah. And you get sole control, right? So it's not like you have a partner and you have to take them into account. You're just one person running a business on your own. And easier tax compliance, possibly you're just reporting all this on your own individual tax return. You don't have to file any sort of separate report for the business because there's no separation. It's just whatever you take in, you report on your tax return, and less paperwork in general. So those are the pros of a sole proprietorship. The cons, and there are some significant ones here, are personal liability. So like I said, if you're doing your business and you cause damage, or if you serve some food out of your food truck or whatever, and people get sick and they're looking to come after the person that served them the food or whatever, they're going to come after you personally because there's no separate business to go after. You don't get any protection. You and your business are one and the same as a matter of law. So that's something to think about. And that's not necessarily the first thing that people think about when they start running a business, is the potential for liability. But, for us, litigators that have seen a lot of things, it can arise from things that you don't necessarily think it can arise from. So it's something to be cognizant of, even if you don't necessarily think, well, why would I be liable for anything? Well, you don't know how everything's going to play out. Another con of a sole proprietorship is it can be harder to raise capital. Banks are leery of lending money to sole proprietorships because it's just one person, and it might appear unstable. Investors might be the same way. You're just kind of giving money over to one person who hasn't even taken the effort to, incorporate a business yet. They might view that as, suspect or not stable and be less willing to invest. And you might have less room for expansion because, if you want to take on somebody as an investor, they might want to have an ownership stake. And so, but you can't really do that if it's a sole proprietorship. So that's an overview. There's no agreement to talk about with a sole proprietorship because there is none. It's just one person running a business. So
Adam, before you move on, I got a quick question then, just out of curiosity. What's probably the biggest surprise you've ever come across with a sole proprietor, somebody who's running a sole proprietorship, right? Like,
yeah,
what has stuck out in your experience of somebody, like whether it's liability or just in the operating?
Well, I'm surprised at the fact that there are people that operate as sole proprietors for a number of years in areas where, there's a lot of different potentials for liabilities and things like that. And they just haven't incorporated. That's kind of the biggest surprise I've probably seen in that area. I think it is good to incorporate as something to give yourself some separation between you and your business, particularly if you're getting serious about it and this is something you're doing all day, every day. And if you have employees and things like that, especially. So that's kind of the biggest surprise I had is I had a business that had been going for a long time and has a pretty significant book of business and they hadn't incorporated into anything. And it's like, well, that's probably time to do something here.
So if I understand you correctly, it's probably starting off starting off the business, it may make sense to start off as a sole proprietor, but at a certain point, when you start thinking about the potential of liability, that's when you need to start thinking about, okay, what other form of entity should this create?
Yeah, I mean, even then, I think if you're going to be serious about it, and we'll get to this, but I think it might make sense just to become a single member limited liability company right off the bat, because it's not that expensive in the grand scheme of things to incorporate as an LLC, and you can just get that taken care of from the beginning. If you're not going to do it at the beginning and then you're running a business and then you have all the pressures and stresses and whatever of running a business that you have to deal with, then this is going to be pushed to the back of your mind and I don't want to deal with that stuff because I have, a to-do list of, 500 things I got to do just to make this business run and, all the other things that I have in life. So that's my take on it. Okay. But in practice, though, you're right. And I think that's the way it happens a lot of times. People just start running their business as a sole proprietor. And then eventually they get to a point where they're like, or somebody tells them, hey, you probably need to do something here, or, there's tax advantages or whatever. Right. So, yeah. So general partnership. So this is a situation where you have two or more partners in the business. And again, there's also no legal distinction between the general partners and the business. And partners share business assets, profits, and debts. And it can be formed orally. I think it's a good idea if you're going to do a partnership to have a written agreement. I had a case where we had to have a week-long trial to figure out if there actually was a partnership there or not. And it was a lot of money at stake because, the person we were representing thought that they had a partnership in place and was operating under that assumption for years. And then they were trying to dissolve the partnership and get some money out. And the other person said, yeah, that wasn't a partnership. So we had to go to trial. And it would have been, if they would have written out on a napkin even, hey, we're a partnership, that would have saved a lot of trouble. But anyway, I think it's good to have some kind of a written agreement from the outset. But as a matter of law, as we argued in this case and were successful, you can have an oral partnership. So there's what's called pass-through taxation, where the profits and losses flow through directly to the partners. So there's not taxation for the partnership, and then when that's distributed, then you pay taxes again to the owners. It doesn't really stop at the partnership. It just goes right to the partners, and then they pick that up on their tax returns. So what are the pros of having a general partnership? It's easy to form. There's no strict need to register anything. Like I said, you can just have an oral partnership even, and that happens, or you can just enter into a simple written partnership agreement with somebody. You can file a statement of partnership authority with the Nebraska Secretary of State with just basic information about the partnership. It can help when you're dealing with banks and things of that nature, and it's not that expensive. And you do need to get an employee ID number to file taxes, because you do have to file a information only reporting return. So it's not like the partnership itself is paying taxes, but you have to report that tax information to the IRS, and then it needs to match up to the people that are the partners that are taking the profits and losses. Has a little bit less paperwork than some other entities. For example, with an LLC or a corporation, you have to file annual reports. It is an easy way to bring someone else into a business. So if you got two people that want to run a business together, obviously two people can't have a sole proprietorship. So you can have a partnership instead. And you can establish ownership and procedures. It doesn't have to be a 50-50 partnership, for example. You can have somebody that's a 75% partner and a 25% partner. And it's relatively easy in terms of tax compliance. Like I said, you file an information-only tax return. Partnership doesn't pay taxes on its own. Okay, the cons of a general partnership is you still don't get any personal asset liability protection from a general partnership. So if you're in a partnership and you got two owners and there's some sort of a liability that would be against the partnership, then the two partners can be, liable on that debt individually.
So when you talk about liability, I just want to break this down a little bit in simpler terms. We're talking that the business owes a debt or owes money for something, or damages, or something that happened that now is incurred an expense that needs to be paid out.
That's right.
Okay, and so there's no, when you say no personal asset liability, that means that if the business owes that debt is actually owed by the partners of the business.
Yeah, so they can enforce. I mean, you could enforce if I have a judgment against the partnership and the partnership has partnership assets, I can enforce against those assets, or I can go against the partner's personal assets. That's the way that works out. So that's what we're talking about here with personal asset liability protection. The partnership is not some separate legal entity where it's like I have a judgment against the partnership, so I can only enforce against partnership assets. If there's not enough assets there in the partnership, I can go after people's bank accounts or the partners' bank accounts, or cars, whatever, enforce against whatever assets they have.
Okay.
So that's for a general partnership. So that's a significant con to a general partnership. And you need to decide. So another con, as opposed to a sole proprietorship, it would be that you need to figure out how you're going to run a business with someone else and divvy up profits and responsibilities. And that's something that people want to think through at the outset, regardless of what you're doing and what form you're going to take. If you're going to bring somebody on board, you really need to think that through. Like, what is the role of this other person going to be? Are they just going to put money in? Are they going to be involved in the business? Am I going to give them decision-making authority about how the business is going to be run? Is there going to be some sort of voting, and do they have a vote? And how many votes do they get, and how many votes do I get? So that's the type of thing that, it's easy to get sideways on that, to, think about in your head. Well, I'm going to be the main person. For example, I started this business, but then I'm bringing somebody else in, and in your head, you're still thinking, well, I'm still the main person. I should be able to call the shots. But then if your agreement, or, the legal treatment that person is going to have under the law doesn't match up with what you're thinking, that's going to, what the actual reality of the agreement, or the legal status is going to carry the day. And so that's, an important thing to consider when you're starting up a business and you want to bring somebody else along. I got to say this, that I'm thinking about things from like worst case scenario, or, when problems happen, because that's what I wind up seeing, right? People don't come to see, well, you should come to see a lawyer when you're trying to get things set up in the beginning, because, an ounce of prevention is, worth a pound of cure and all that stuff. But, I'm a litigator, so I'm dealing with problems that are already occurring. So, that's the way I view the world a little bit. And that's, everything I'm saying is tainted with that. But you never know when situations are going to teeter over into the world where somebody like me has to get involved either. So it's good to kind of think through these things, but these are the types of things I would think about when you're trying to bring somebody into a business in general, as opposed to just having a sole proprietorship. And the last point here is that, as opposed to a sole proprietorship, if you bring in a partner in a business, you owe duties to that partner, right? So that's fiduciary duties. I mean, what does that mean in practice? Well, it means, for example, if I have a partnership with somebody to, let's say, buy real estate and develop real estate. Okay. So I can't necessarily, unless we, carve things out in the agreement, but I can't necessarily just go and compete against the partnership. Like, let's say there's a house right next door to the house that we're trying to develop. And I'm like, well, I want to buy that house too and develop that house, but I don't necessarily want to do that with my partner. Well, you might not be able to do that, because you owe duties to your other partners to, present opportunities that would be the type of thing that the partnership would do to the partnership. So, that's something else you want to think about, is that if you go into business with somebody to do a certain type of business, you can't necessarily just go on your own and do something else in that line of work on your own, because you might be breaching your duties to your partner. You're kind of potentially constraining yourself a little bit in terms of, I have this business with this partner to do certain things. I can't necessarily just go out and do things like that on my own without talking to the partnership first or bringing it to their attention.
So what would be a consequences of this breach of these fiduciary duties? Like, so in your example, if you and I were in a real estate deal and we were general partners, and you were like, hey, I'm going to go buy this other property and compete against the partnership, what would be your consequences?
Well, yeah, I think you could get sued by the other partner for, breaching the fiduciary duties, and then they could make you, disgorge the profits that you made. Like, let's say I sold this building for a lot of money. They could make the argument that, well, that should have been a partnership opportunity. We should have been doing that through the partnership. So I should get a share of the profits that you made on your own, because that was wrongful. And then, obviously there's wrinkles to all this, but that would be the general argument that the person would make, is that, you shouldn't have done that on your own. You should have presented that to the partnership, and the partnership should have been able to go out and do that business. And I'm a partner in the partnership, so I should have made money off of that. So, okay. So these are things to think through, when you're in business relationships with people, that you do start owing duties to people, and you can define those duties to a certain extent in your agreements, but you got to think about this stuff a little bit.
Do those fiduciary duties include, like, time or like a dedication to say, okay, one partner is operating, all the business, the other partner is kind of silent doing another business. Is that part of that fiduciary duty that both have to contribute both their equally time, or is that based upon whatever the agreement is?
Yeah, that's based on what the agreement is, because you can have people that are just kind of investment only partners and they don't have to really do anything else. It's really like where this comes up a lot is when people are being disloyal to the partnership by trying to take opportunities for themselves or using information that they acquired through the partnership, and then trying to get some benefit from that outside of the partnership. That's where a lot of this comes up. I mean, if you're kind of a bad partner and don't really, in terms of like not putting forth your best effort, I think that's just more likely going to get the other person to want to get out of the partnership and dissolve it or something. But where the duties, I think, really come into play, and where this most commonly comes up, is when people like are being disloyal to the business and thus disloyal to their partners.
Okay.
All right. So if you're going to have a partnership, you don't strictly have to have a written agreement. You can have an oral partnership, but I do think it's a good idea, I think. And so, what are some issues to consider addressing in a partnership agreement? Well, I think one of them is, what's the scope of this partnership business? Like what's the partnership going to do? What's our business? And that's important, one, so that everybody's kind of on the same page about, what type of business you're going to have. And two, when we talked about those duties, one of them is the duty not to compete against the business. Okay, well, let's say, I got a food truck business, but then, I want to, hire some people to, go do construction work or something, right? Well, that's not competing against the business, right? So if you have a partnership agreement that lays out the purpose of this business is to, have a fleet of taco trucks that serve, downtown Omaha or whatever. And then, and then you have another business where you're, doing construction or, consulting services for something unrelated to taco trucks and, whatever. And then you're not really competing against the partnership, and it's pretty clear. But if it's really ambiguous about what this partnership is doing, then, it's hard to tell, right? Like, well, I don't know. Maybe the partnership was in both the food truck business and the construction business. I don't know, right? And then you're down to what conversations did you have and things like that, and it can get muddy. So I think it's good to spell out, what's this partnership doing? What's the business of the partnership? And then everybody's on the same page, and then what you can and can't do as a partner to compete against the partnership. Another thing is, let's say we have two partners, but then somebody else wants to come in. Okay, well, what's the protocol for admitting new partners? How does that happen? Did both partners have to agree to it? The next one is, pretty important. How is the partnership going to be managed, right? So do decisions have to be made by a unanimous vote of all partners? Or, let's say we have 5 partners, is a vote of 3 okay? And are we voting based on pure numbers or ownership interest, right? Like there's 5 partners, but I'm a 30% owner and somebody else is a 30% owner. And, now I'm running out of math. 2 are 15% owners, and one's a 10% owner, and that probably adds up to 110. But so anyway, do I get to vote my 30% interest, or am I just 1 vote out of 5? That's important to think about. Obviously, if you're going to be like, I'm going to be the 60% owner and then everybody else is going to share the 40%, then you probably want the voting to reflect that, because otherwise you're going to get outvoted. And then, like what decision, can you delegate things to a committee, right? Like, can we have a subcommittee of partners that have certain authorities, things like that. So and it doesn't have to be super complicated. I mean, if you're just kind of starting out and you got 3 partners, you can just say, majority vote, things like that. You don't have to get super granular, but you do want to think about it a little bit, and now you're going to have meetings, annually, things like that. How are they going to occur? Can they occur over the phone? Stuff like that. Are you going to have different classes of partners with different rights? So, for example, maybe you have one person who's going to actually actively manage the business, and then you have a limited investment only partner that's just putting money in, and they're not really going to be involved in the running of the business. So maybe they don't have the same rights. Maybe they don't vote. Maybe you have 3 people running the business, and one person that just put in some money is a limited partner and isn't going to vote on any of this stuff. How revenues are going to be distributed. That's an important one. And how the partnership can be terminated and wound up, right? So if you got 3 partners, do they all have to agree to terminate? Or, if 2 or 3 want to end the partnership, can they vote to do that? And how are you going to wind things up? And, I should say that there is a whole series of statutes in Nebraska that set sort of default rules for all this stuff, but you can kind of customize things too. And there's advantages to doing that. So those are types of issues to consider. All right. Now, the next one is the limited liability company. And, like Trolls and Mariah Carey, this is something that really took off in the 90s. This is interesting because it's not something that was really around for a long time. And so you get older businesses and they're not limited liability companies, but now, newer businesses, tons of them are limited liability companies. What it is this hybrid between a partnership and a corporation, which we'll discuss next. And so it has one or more, quote, members, which is just another term for an owner or a shareholder or, partner. It's just the way that's the nomenclature for that. And a limited liability company, unlike a sole proprietorship and a partnership, is its own entity. It's a person, if you will. It's not a natural person. Obviously, it doesn't breathe, but it's a person on its own in the eyes of the law. So what that means is that it provides liability protection for personal assets. So if I'm a member of a limited liability company and the limited liability company has debts and they default on those debts, then whoever the owner of that debt is can't automatically go after my assets. They have to go after the assets of the limited liability company. Or if, somebody gets food poisoning out of my taco truck and they sue the limited liability company that runs the taco truck and they get a judgment, they can't come after my assets to satisfy that judgment necessarily. There's, like everything, there's wrinkles to this. And sometimes you can try to what's called pierce the veil between the owner of the business and the business, but there's a whole thing about that. There's a whole analysis, and it's not automatic, and there's things that they would have to show. So that's a benefit of a limited liability company, is that unlike a partnership, you do get that separation of you personally and the business. Okay, now as far as taxes, it's a pass-through tax entity like a partnership. So a limited liability company doesn't pay its own taxes. Its members pay the taxes. So the limited liability company goes to an accountant. They issue K-1 statements to all the members saying, hey, here's what your share of the profits of the limited liability company were, or the losses, if you had a bad year. And then you personally have to go to your accountant and put that on your tax return and, pay it or take the losses or whatever. The limited liability company doesn't do that. The limited liability company does have to file information only return that shows, how they were allocating things, and then that needs to match up on the people's individual, the members' individual tax returns. All right, so it's relatively easy to form a limited liability company. You have to file a certificate of organization with the Secretary of State and pay a filing fee. And that certificate of organization is a one-pager. It's just, basically like, what's the address, that type of stuff. And then you have to appoint a registered agent. And what that means is that if you're a limited liability company, you have to appoint somebody that's going to accept service of lawsuits, so that, if you're out there operating and somebody wants to sue you, then they know who to serve. And if you serve that person, then you've accomplished service and your lawsuit can continue. You have to prepare an operating agreement, which is the agreement that governs and sets the rules for a limited liability company. Register for an employee ID number so you can file taxes. There's a publication requirement, where I forget what the paper, but it's like we have to have an advertisement in a local paper, like a classified ad, saying that, hey, I'm going to form this limited liability company, which is totally antiquated. And I don't think that many people are scouring the pages of the newspaper to find out what new limited liability companies are coming down the pipeline. But that's what the statute says. And then from there, you have to file a biennial report with basic information about the LLC, which is basically just name, address, and registered agent going forward.
So, Adam, out of curiosity, because on here you're saying that you must prepare an operating agreement for the LLC or a limited liability company, but does that include even if you're a solo or one member only LLC?
Yeah, I think you probably should still prepare an operating agreement. I'm actually not 100% sure if that's a legal requirement that you do that, because you don't file your operating agreement, but I think it's a best practice nonetheless. That's a good question, actually. So what are the pros of having a limited liability company? Well, the one is that, you have personal asset liability shield. Daddy. Hey, Peter. Hey, buddy. Just a second. Sorry, I'm at home and my 5-year-old just walked in trying to.
In the days of post-COVID, I think that's normal.
Yeah. So, you have a personal asset liability shield. We kind of talked about that. You can have a single member LLC. So if you want to still be doing your business on your own, you can have a limited liability company and you're the only member. So you don't have to cede any control to anybody else, but you'd have some separation between you and your business. You might be viewed as more credible by, lenders or customers or banks, things like that, but the one thing about this is that, if you're getting a loan and you have an LLC, obviously banks understand how this works. So they're often going to ask you to sign a personal guarantee on the loan, so that you will be personally responsible, because they understand, if this LLC doesn't have enough assets, then we're out of luck. So that can happen, and frequently does happen. And another advantage is that you can set forth an operating agreement that says how the LLC is going to be managed, and the ownership percentages and dispute resolution procedures and procedures for ending the business and all that stuff. So that's an opportunity for you to craft how your business is going to run and set some rules there. And then you can also appoint, one managing member and then have more passive members. So if you want to control the business in terms of its day-to-day operations, but get more people into the business that might be putting, capital into it, this is a possible way to do that.
So so out of curiosity, let's assume that, I have a one member person LLC and I have my operating agreement, who's that operating agreement going to? I mean, that's it's not being filed with the Secretary of State, correct?
No, you just have it to run your business, and well, like lenders will ask you for these types of documents sometimes. If you're getting a loan for your business, they're going to want to see all your certificate of corporation and your operating agreement and all that stuff too. So that's probably primarily who that's going to go to is a bank if you're trying to apply to a loan in terms of any third parties.
Okay. And so let's assume that I have more than one member in this LLC.
Mm-hmm.
What are the consequences for breaching the LLC, or the operating agreement?
Well, they can be serious. I mean, it depends on the situation and what the breach is, but you owe duties to the people that are also the members of the LLC. And it depends on how the LLC is managed, exactly what those duties are and the scope of them a little bit. But, bottom line, you owe duties. And it gets back to what we're talking about with the partnership a little bit too, that you can't be disloyal to your co-business owners, right? So you can't, if the operating agreement says this limited liability company is in the business of, let's say real estate development broadly, not just one specific property, but just developing any real estate. And then you go out on your own and you develop some real estate on your own and sell it and don't give that opportunity to the limited liability company, then you breach the operating agreement and you can be liable for that because you were disloyal and you took an opportunity that probably should have gone to, or at least been presented to the limited liability company. And there's other ways you can breach the operating agreement too. And, those can have ramifications. And an example I'm thinking of there is that, limited liability companies will sometimes have, restrictions on transfer of ownership interests. Mm-hmm. And you can, if you went out and just sold your interest to somebody else without following those restrictions or giving the company, the limited liability company, a chance to buy them back, which they have in the operating agreement, then, they could invalidate that sale and, stuff like that. Now, hopefully nobody would just buy that and then not look at the operating agreement and see, well, wait a minute, you're supposed to do this, but things happen, right? So that would be another example. So yeah, those are, and there's all kinds of other things that could happen too. I mean, if I'm a member of the LLC and the LLC is supposed to have annual meetings where we have votes on things and then they don't do that, or like the majority owners of the LLC just kind of make all the decisions without a vote, without me, that's what's called oppression under the law. And that's kind of a mixture of, you're probably breaching some stuff in the operating agreement and you're probably breaching some kind of common law duties to, let people be, have the ability to participate in the business and get some sort of potential for return on investment. So that happens too. I've seen that where, 3 members of the LLC decide they don't want to deal with this other person anymore. So they just kind of freeze them out. They don't have meetings. They don't vote on things. They just kind of do stuff and run the business on their own and don't include this person. That could be a breach of the operating agreement. And, then that person's remedy is to file a lawsuit. And, usually not usually, but a lot of times the remedy for that is that those people have to buy out that fourth person at a reasonable price. So, it's important. It's important to think this through. It's important to set up the rules for your business, which is going to be, in this case, your operating agreement or your partnership agreement, if you have a partnership. And it's important to follow them. And it's important to just set things up the way that you want things to run and actually think it through. And yeah, go ahead.
So for our members that don't have that are LLCs or partnerships and that don't have an agreement, I think you touched on some of this, that there are default rules that come into play. Is that correct?
Yeah, for LLCs too, there's a whole limited liability company act, series of statutes. So, those are all the default rules that come into play as well. So, and then you have to but then anything you put, it's kind of complicated, but if you put something in the operating agreement that is different than the statute, then the operating agreement is going to usually be what is going to govern, except for if you're trying to get rid of like some pretty basic things. So there's certain things you can't, and that's kind of in the weeds discussion, but generally speaking, the more specific document that everybody agreed to is going to apply over the very general statute that's only kind of there as a backstop.
Okay.
So, the cons of a limited liability company, you have the same cons of a partnership in that as compared to a sole proprietorship, in that basically you have to run a business with somebody else, and you should think about that and whether you're willing to do that and and on what terms you want to do that. Okay, so if you're going to draft an LLC agreement, what should you think about? And these just a few issues. The scope of business is important, and again, this goes to the duty not to compete. I've had cases where that's a huge question, and maybe it wasn't as specific as it. Well, I know it wasn't specific as people hoped it would have been, after the fact, right? Because they wouldn't be there otherwise. So, you want to think that through. Like, are we in the business of, just one very specific project, or are we in a very broad business where we're going to just keep doing projects over and over again, or, keep running an ongoing concern, right? And that matters especially when it comes to what duties you have not to compete, because, a lot of people are entrepreneurs. They don't have just one business. They have multiple businesses. They have a lot of ideas, they want to do a lot of different things, and then they're not necessarily thinking about this piece of it, but that's an important thing to think about. The admission of new members, like how are new members going to be admitted into the LLC? Do we have to have a majority vote? Does everybody have to agree to let somebody else in? And then restriction on transfer of units, and in units is just, shares or ownership interest for an LLC. That's just how they're called. Right. So, these are closely held businesses. So people don't necessarily want somebody to be able to sell their business interest to some stranger to be able to come in. So the owners of the business will often put in a restriction where if I want to sell my interest, I have to first, offer it back to the other members of the LLC or the LLC itself, and to buy me out first before I can sell it to, somebody they don't know and don't necessarily know if they want to do business with or not. How is it managed? So you can have a manager managed LLC, which means that you appoint one person as the manager of the LLC to be, calling the shots on the day-to-day operations. And then maybe on certain issues, all the other members get a vote on it, but that person is running the business on the day-to-day. But that could be set forth in the agreement, or otherwise, it's not clear. If it's not clear that you're appointing one person to be the manager and you have four members, then, it's assumed that all four members are all together running the business. And that matters for a variety of reasons, not the least of which is to, know who's on first and who has authority to do X, Y, and Z. It also matters legally because, the person that's supposed to be in charge might have more duties than other people that are just kind of passive investors, things like that. Obviously times and place of meetings. Are we going to have meetings? Different classes of membership units with different rights. So maybe you have voting units and non-voting units. How revenues are going to be distributed. That's important. How the LLC is terminated and wound up is important. And modification of duties. So what this means is, there's a statute that imposes a lot of duties, but you can say in your agreement, hey, we're going to be like a real estate development LLC, or we're going to set up a food truck, but there's no restriction on any member going out and doing stuff on their own, right? If you set that forth in the agreement, you're fine. Then you can do that. You have to agree to it. Sorry, my 5-year-old just popped back in the room. So, these are important things to think about. It's a pretty flexible business structure, and you can kind of make it what you want it to be. And like I said, you can set up an LLC pretty easily and just, get some basic agreements going, and then off you go. Or you can make it more complicated if you feel like you need to.
Now, are these operating agreements set in stone? Like, if you come up with this, today, and you're starting your business today, how would one go about changing it?
Yeah, you can amend it for sure. And that's actually, I should have put that on there. That's another thing you can set forth in your agreement, is how procedure for amending the agreement, right? So yeah, there's, I see it a lot of times, second restated and amended, operating agreement, where they decided that they needed to change things and X, Y, Z. So yeah, you can definitely amend it. And, that usually comes out about if, business grows, or you add new members in and you have to change the decision-making processes or voting procedures or things like that.
Okay.
Yeah. Okay. And the last one is the corporation. And, until the 90s, when LLCs became a thing, and actually for some jurisdictions, it was even later than then, a corporation was kind of the only way to get, protection from liability for your assets, right? It's like, well, I have to create a corporation. So I see it a lot, businesses that started in the 80s or 70s, they're still corporations because the LLC wasn't available then. So it's an entity separate from its ownership. So again, that means that, you can't enforce liabilities against me personally. You have to go after the corporation and its assets, even though I'm an owner of the corporation. It issues stock, right? So LLCs have units, corporations have stock. And what we're talking about here is really closely held corporations, where there's a small group of owners, and private, obviously there's publicly listed Amazon or whatever, and that's a whole different ball of wax. But, even for a private, closely held company, its stock is what is issued. And it's subject to corporate taxation, or, what people call the double tax when they talk about corporation. And what that means is that, so the corporation itself has to pay taxes, right? So the corporation made a profit of X dollars, go to the corporate tax rate. The corporation has to pay income tax on that. And then the corporation has to pay, the corporation can choose to issue dividends to its shareholders, and then they have to pay taxes on the distributions from the corporation to them. So that's what people call double taxation. Whereas with a limited liability company or a partnership, it all just flows to the partners or the LLC members, and then it's only being picked up on their personal tax returns. How to form a corporation, it's a little more complicated than forming an LLC. You have to have a registered agent. You have to prepare articles of incorporation, which is, again, is kind of a one-pager, just general info about the business and its address and stuff like that. Corporations have what are called bylaws, which is just, the LLC has an operating agreement. Corporations have bylaws. It's just the rules for how the corporation are going to be governed. Now, the corporations do have to have directors, which are kind of people that are appointed to make decisions about how the company is going to operate. And then they can also have officers, like a president or somebody that's making day-to-day decisions, but then they have other things that have to be approved by a board of directors. So there's a little more complicated corporate governance that has to happen with the corporation too. And then you have to determine what your share structure is going to be like and issue stock. You can have different classes of shares with different rights. Register for an employee ID number. There's a 3-week publication requirement, like with the LLC. And then you got to do biennial reporting, just like an LLC, with basically just basic information about the address and who the registered agent is going to be. So,
and so just for clarification purposes,
yeah.
The public, some of what you're talking about is Nebraska Pacific, right? Like we're talking, these are the laws of, this is requirements for Nebraska.
That's a good clarification. You're exactly right. So, I mean, and I think these are kind of general requirements, but, I don't know for sure.
Okay.
So if you're in Iowa or wherever you are, Illinois, Missouri, they might be a little different. Pros of a corporation, you get this just like an LLC, you get the liability protection.
Yep.
And just like an LLC, you may seem more credible to a bank or lenders. And as compared to an LLC, maybe there's a way, there might be some advantages for being able to issue different classes of stock to different types of owners or investments. But honestly, I think that if you're starting a closely held business, LLC is probably the easiest way to go. And there's a reason why it's become popular, is because it's flexible, it's easy to set up, and it gives you liability protection in something that is easy to set up quickly. So the cons of a corporation, there's more paperwork to register, more corporate formalities to observe. For example, you have to have a board of directors and have board meetings and stuff like that. Whereas, if you only got like 2 or 3 people that are going to work together, or one, obviously, it's just a lot easier to have an LLC, and you could appoint one person to be the manager to make the day-to-day decisions. You don't have to do as much of this type of corporate formality type of stuff. You don't have to have a board. Right. And then, a big thing that people don't like about corporations is, I talked about the double taxation, where corporation has to pay taxes, and then when it's distributed to the ownership, then they have to pay taxes again on their individual returns. So if there's a small group of owners and it's all just going to flow through to them, it's probably better from a tax perspective just to have it flow through in the beginning, and then they pay it on their own taxes. So, and then issues to consider, and we're running out of time, so I'll just kind of breeze through this. I think they're pretty similar to an LLC. You want to set forth what the scope of your business is. Again, this is important to determining the duty not to compete, because if you're running a closely held corporation, it's the same deal. Owners of a closely held corporation can't just go out and set up a competing enterprise to the business in which they're an owner. New sales of stock, restrictions on transfer, those types of things. That's similar to an LLC. You do have to have officers and a board in a corporation, so that's a little different, how you're going to vote on officers and determine board members. When you're going to have meetings, different classes of stock, how you're going to distribute your revenues, and termination and winding up if people want to end the business. So these are important things to think about. I just threw this slide in just to emphasize that the stuff we're talking about with your business entity can be different than your trade name. For example, I can be, my initials are ARF, because I don't know why they didn't think about, that's going to be the sound that a dog makes. So let's say it's ARF LLC is my business, but, I want to have, Clean Cuts Mowing be my trade name. Right. So, I could do a DBA, or doing business as name, where, it's ARF LLC, DBA, Clean Cuts Mowing. And so that's a separate deal. And that's really on the business side of things, how you want to market your business. It doesn't have any legal significance, except for the fact that if you register it, then, somebody else can't come along and take Clean Cuts Mowing for their mowing business. But there's a whole process to do that. It's relatively straightforward. You just apply for the name and pay a fee basically and publish notice, and then you have to renew it every 10 years. But I put that in there just for people to understand that that's a different thing. Like if I register for a trade name, it doesn't affect what legal entity I am, and the name of my legal entity can be different than the trade name that I use.
Perfect.
All right, so some final thoughts. Basically, it's just, I know as an entrepreneur, you already have a long list of things that you should be thinking about. So unfortunately, I'm adding to your list. But I do think that, it's worth considering as a legal matter how you're going to legally structure your business, because, liability protection is worth something. And LLC, like I said, is popular for a reason because it's relatively easy to set up, but it does get you that separation between you individually and your business. Another thing to think about is, and this is a global thing, whether it's a corporation or a partnership or a LLC, is that once you go into a business with somebody and you own ownership interests, it's hard to sell those interests to somebody else outside of that business, because, especially if you have a minority stake, right? Because first of all, there could be restrictions on transfer where you can't just go out and sell it to a third party without, offering it back to the company. But then the other thing is, I don't necessarily want to just go buy a minority stake in a business that I'm not going to run with people that I never met before, right? So you have a limited market for that. And it can be tricky to value, what is this? What is the value of this business, right? You could get 3 different appraisers that could have 3 different determinations of that, right? So it's not like, stock of Google or whatever, where you just look it up on the website and, oh, I know it's, whatever a share today, right? It's kind of hard to determine. So, that's something to think about once you get in, and especially if you're putting money in, it can be a really good investment, but you want to think through, like, do I really want to do this? Because I'm committed and I can't just, get out of here real easily. I mean, there's ways to do it, but it's not as simple as just buying stock on Vanguard or something. And then I want to sell it tomorrow. Okay. You can sell it tomorrow. And I do think it's important to draft and follow whatever agreement that you're gonna have govern your business, and if things change and if you're running your business differently and everybody agrees to that, just amend it so that 10 years later when you have a dispute and the agreement says X and everybody's like, yeah, but we just decided to do Y. Well, that's not what that says, and then you got a whole issue about that. So an ounce of prevention is really worth a pound of cure here. But on there, but then on the other side, don't assume that just because you have an agreement that says that things are going to go a certain way, that, the fact that you're doing things different doesn't have any consequences, right? So if for example, if there's a dispute and you say, well, it says right here that, it's supposed to go this way, but then you've been doing it a different way for 10 years, then that can change, as a matter of law, what, if you have a dispute, what the agreement really was, because you agreed to do things differently for a long time. So yeah, and final thing I would say is that, the agreement should be your friend, in that it helps everybody get on the same page about, okay, we're going to be in this business together. What are we doing? What are our expectations? How are we going to decide things? How are we going to run things? So it's really an opportunity for you to get that out in the open and agreed to, and take away uncertainty at the beginning. So that's what I got for you.
Thank you so much, Adam. This is hands down quintessential way to prevent future disputes and litigation in a business. And for our members that have a business, or our members who are looking to create a business, as you go through your business plan, the operating agreement of what the entity is and how it's going to be ran should be part of that process. And if you need any additional information, Adam, I'm sure that you're available for consultations or anything to help these small business owners even think this through. And you're at Lamson, Dugan, Murray, correct?
That's correct. Lamson, Dugan, and Murray. We're in Omaha, Lincoln, and Des Moines. I'm in the Omaha office, but yeah, and just Google me. Lawyers are easy to find on the internet.
So. Not all good lawyers, though. So without any further ado, Adam, thank you so much for your time. We are out of time. This has been phenomenal. Once again, this is the Power Hour brought to you by the Ewing Marion Kaufman Foundation, and we are the Midlands African Chamber. Come join our tribe. Thank you.
Thanks, everybody, for your attention. Thanks for coming today.